Well, the global financial crisis has been an amazing stress test for Australian companies, including those on Morningstar's list of best businesses. Here to tell us more about it is Morningstar Head of Equities, Andrew Doherty. Andrew, thanks for coming in.
Hi, Nicole.
So, Andrew, how have Australian companies fared in the downturn?
Well, all companies have been affected to some degree, but those most affected include those that are exposed to discretionary spending. So, there was a rapid decline last year in business and consumer confidence. And this has affected companies like in the media sector, where there's been a rapid decline in ad spending. Also, building products and building materials companies have been affected by weak property and commercial construction markets. Financial services companies have been hurt by the downturn in asset prices and fund outflows. And also, of course, highly geared companies were under extraordinary pressure through the credit crisis. And there have been a lot of disaster stories, particularly in the REIT sector, but also other sectors.
So are these companies very strong, or are there other factors propping them up?
Well, it's very valuable to have a look at those companies that have managed to grow earnings during this period, because it may indicate companies that are very strong, like they may have very robust and growing earnings streams, which is really the kind of company that we're after to invest in. Or otherwise it might just be some short-term circumstance that's just propping up performance in the short term. So we had a look at our coverage list, and we cover 250 companies, and there are 180 companies that released their results in the most recent reporting season during August. And of those, 44% of companies grew earnings per share last year. So that's not a great number, but if we have a more strict criteria, we also looked at companies that grew earnings per share last year, but also where our analysts expect earnings to keep growing this year and next. Only 20% of companies comply with that criteria.
What kinds of companies are doing better than others?
So there is earnings growth in companies involved in non-discretionary spending. So Woolworths is the real standout there. People do keep spending during downturns on basic groceries and household goods. Also healthcare services companies are still managing growth in many cases because people keep spending on healthcare during downturns. There's a number of commercial services suppliers that are continuing their organic earnings growth trends, so Computershare and Iris are examples of those. Also, brewers continue to keep growing, so Lion Nathan and Foster's, for example, are still maintaining earnings growth because Australians still love a beer. Also, gold companies have grown earnings recently through the rise in the commodity price and also some increased production in certain of the businesses.
Before we go too much further, maybe we should explain what a best business really is.
The best businesses are those companies we regard as the very best long-term investments. So here we're looking for companies with robust balance sheets, strong cash flows, economic moats, so they'll have very strong defences against competition. And importantly, we want robust and growing earnings and dividend streams. So we really have set the bar very high here, and only very few companies will ever comply with the criteria.
So how have the investor returns gone for the best businesses?
Well, the performance really is very good. So we looked at total return, which is share price performance and dividends. So over the last year, the market has returned 2%, but the best businesses has returned 7%. So really strong performance over that 1 year period.
And what about the longer term? Do you have some figures for that too?
So over the last 5 years, the market has returned 10% per annum. And the companies that we had on the best business list a year ago have returned 14% per annum over that period. So very strong outperformance. But, we cut 4 businesses from the best business list over the last year. So if we take those businesses out of the returns, the performance over the last 5 years is 17% per annum. So very strong performance there. And really the point is that people don't need to take big risks to earn decent returns in the share market. It's far better to focus on high quality businesses where decent and reliable returns can be made.
Thanks for your time today, Andrew.
Thanks, Nicole.